So that additional rate of tax, the reduction in the threshold above which it becomes payable from 150,000 to 125, 140,000. That's £125,140 is what I meant, from the 6th of April next year. What does that mean for planning as we head towards the end of the year? What does it mean, if anything, for planning as we head towards the end of the year? Well, I think it means that if you have the control over income or any money that is subject to income tax, and you can generate it in this year when it would be subject to 40% rather than 45%, then it will be worth doing that. If you have any amount that you can pay, contribute, that will generate tax relief, obviously on a pension contribution, most obviously, in the current tax year, where it would only just justify 40% relief, but if you left it till next year, it would get you 45% relief. Then those two things will be worth considering, all other things being equal, subject to commercial considerations. So let's take that first possibility first. That is the generation of income or taxable amounts in this year at a lower rate of tax than they would be if you generated them in the next year. So we're talking effectively of amounts that fall between £125,140 and £150,000. If you could generate dividend income or that bonus payment from your own business in this year, and it will be subject to a lower rate of tax in this year than next year, then of course that will be worth doing. Of course, if it's dividend income, we'll be talking about that additional rate of dividend tax, the 39.75%, as opposed to the 32.5% that it will bear if it were generated in this year. So that's worth considering. If it were a bonus, then we'd be looking at the straightforward 40 versus 45. If you have an investment bond and all other things being equal, again, commercially, economically, it doesn't really matter to you whether you encash the bond this year or next year. If it is going to generate a taxable gain, and if that gain would be subject to 45% tax if generated in next year, but only 40% if generated in this year, or 20%, 25% respectively if it's a UK bond, then worth thinking about making the encashment subject to the economic and investment conditions, of course, in this year rather than next year. The other side of that planning coin is the getting of relief on payments into pension arrangements. Again, all other things being equal, subject to commercial considerations, etc., and getting invested early, all of that, then the value of the tax relief that you will get by making the contribution next year, if you will get 45% tax relief on it next year, would be greater than if you made it this year and got 40% relief. I would stress, of course, in making all of these decisions or giving thought to all of these possible actions, we keep very firmly in mind not to let the tax tail wag the dog.